The other way to soak up the money, if you have to, if there's no other way, is to have the central bank sell bonds. And this is not going to be a Treasury, but it's going to be a Federal Reserve note, which will compete against the Treasury. And actually, there's a lot of damage, I think, done by doing that because which is going to be the first-class citizen in the debt market? The central bank debt or the government debt? Well, the government debt they don't have much in the way of liquid assets anyway, and not much that's earning interest.
Or a printing press.
And they might have to get paid by printing press after they take it back from the Fed. But the Fed is a great bank. Look at this. What's their cost of money? 0.25 points. How can you not make money as a bank with a cost of money of about 0.1%? And they got this $2 trillion. By the way, and we went through the losses, and yes, there's going to be losses out of that risky portfolio now. But the point is, the Fed bonds will sell at a much higher price and a lower interest cost than the Treasuries. And as a matter of fact, I think the damage gets done is it causes the market for the first time to wake up and say, goodness gracious, the Treasury's not really the riskless rate of return. And then they might start having to pay spreads relative to the Fed rate, which is a better credit. So I think basically it's going to cost us a lot if we do this, because people for the first time analytically will take a look at the credit of the Treasuries as compared to the credit of the central bank. So I think a lot of damage will be done. We can handle, and who knows exactly how all this is going to handle. My own thought about it is, I'm not fearful of inflation. I pray for inflation. The reason I pray for inflation is the only way you get it is you get a lot of spending in goods markets. And so we're made whole. Furthermore, if the price level rises, we get out of the quad 3. In other words, the real cost of retiring debt with falling prices becomes a lot easier. Remember in the inflation of the 70s, we had a lot of fun borrowing money, and then prices rose, our wages rose, and it was a lot easier to pay it off. So pray for inflation is my attitude, as long as it's not excessive, and the Fed could stop if it becomes excessive. So I am not obsessing over it, except to hope it happens. So anyway, that's where we stand. One last thing. What all this scenario has done has created 4 scenarios of expectations in the market. And they all are getting priced. About 6 months ago in December, and this is June, yeah, so it was 6 months ago, I wrote this memo. I'm chairman of an investment committee of an insurance company, so I had a praise management of what's going on. I said, really, there's 6 sets of expectations. Excuse me, there are 4 sets of expectations that you hear night in and night out on CNBC. And the 4 sets of expectations held by different people, independently of each other. One is the dreaded debt deflation. We're going to have what we're having, which is deflation and a recession all in one. And it's hard to get out of, as I described. So indeed, and those folks would, I guess, from that, they'd have a message that if you're going to have a deflation, I guess you run and buy treasuries, because you buy the highest quality, least defaultable fixed income in the event of a recession, and you're going to be helped by the deflation. And we did, by the way, in terms of the tips and the Treasury spread, it reflected a 2% expectation in November and December, an expectation of 2% deflation. So that got priced back then. The second scenario that you hear independently at the same time is the Fed has saved us. We're in a typical post-war recovery. And just like the last 60 years, every time we got troubles, the Fed stepped in with lending. They even did it bigger this time. Don't worry about anything. Buy stocks and bonds. So risky debt prices rose across the board. Joel, what was November? What was it? The junk index was 2,100 basis point spread, and now you tell me it's 1,200?
Probably under 1,100.
1,100, oh my gosh. Which, by the way, raises the question, was the risk worse today buying it as opposed to in November? I wouldn't touch it today at 11 because the past defaults have well exceeded in a garden variety recession. Default losses of 11%. So it's very hard for me to jump in the fixed income market for 2 reasons now. Because I think the Fed has saved us boom has gone way overboard and are totally discounting the risks ahead of default as a result of prolonged recession. The third scenario that was being voiced last December that also got priced is the monetarists and the other folks fearing inflation. And indeed, the inflation risk got priced, and the biggest way that got priced is commodities rose, and the other way is the tips rose quite a bit. So you simultaneously have some people thinking deflation and are pricing for it, and other people thinking inflation. You have different armed camps, and they're all getting their asset of choice lined up. All right, the fourth was, and I frankly, this is the one that scared me the most, thinking that the combination of the over-the-top federal spending and the over-the-top Fed performance was going to create an expectation that the dollar is done as reserve currency. And so those people, their reaction is to get out of the dollar assets and go into other assets or go into gold, whatever. So basically, out of this whole scenario and madness, you had different people looking at the same problem and coming up with different conclusions, and so much of it was based on their past history and training. And all four of these scenarios got priced, all four of them, simultaneously. And they're inconsistent with each other. But nonetheless, that was for the last 6 months. Where we go from here, it's hard to say, except we're going to have, I think, a greater appreciation of the fact that we're not saved. And what goes along with a greater appreciation that we're not saved is that corporate securities and private securities that are subject to default will get priced for it. But they're going to have to see some of it. The typical pattern in recessions is that corporations are able to hang on for a few years where they have enough cash to continue to make the debt service, but the minute they run out of cash, they can't make the debt service, and the great majority of the defaults occur like 2 or 3 years into the recession. So we haven't even seen really the default capabilities, bank loans too. So we really haven't really seen the kind of losses that could possibly mount in this kind of situation. So I can't get excited about corporate claims, either debt or equity. I can't get excited about buying treasuries because of the funding ahead. The only thing that seems to make sense to me is to gravitate to the growth areas that are much less impeded by our current situation, which is the emerging markets. And it also gets you out of any dollar risk and find yourself an emerging market that doesn't have a budget deficit or one that can easily fund it like China. So in any event, that's where I end up, and I guess what I'll be doing for the rest of the summer is about every 3 weeks or so put some kind of update on LouSpellman.com, and more would have to do with, well, both the economy as well as financial markets. And when fall returns, and I got to do this twice a week in class, and I'm thinking about it all the time, I'll probably do it every 2 weeks. But otherwise, I thank you very much for your attention. It's been long.